Did you know your favorite shopping app, ride-sharing platform, or even your smartphone could soon become your bank? Without realizing it, you may already be dabbling in embedded finance, a quiet upheaval rewriting the rules of money. Over the next few minutes, you'll discover how Amazon, Apple, Uber, and others are stealthily supplanting traditional banks, and what that means for your money, your business, and your future. Buckle up. Banking as you know it is dissolving into the apps you already use. What is embedded finance? At its core, embedded finance means weaving financial services, payments, lending, insurance, investment tools, even digital bank accounts, directly into non-financial platforms. Instead of redirecting you to a separate banking app or website, these services live inside the apps you already open daily. The result? Finance becomes invisible, integrated, and seamless. You don't go to the bank. The bank comes to you wherever you already are. Consider real-life examples that show this in action. Uber. Drivers no longer wait days for pay. With Instant Pay, they can cash out earnings up to 6 times a day directly to a linked debit card, often for a small fee or free with an Uber-issued card, transforming the rideshare app into a mini banking portal. Apple. The wallet app isn't just for boarding passes. Apple Card users enjoy a sleek credit card experience integrated into iOS. Apple Pay lets you tap and pay almost anywhere. Apple even launched a high-yield savings account, offered by Goldman Sachs, with APYs north of 4% at introduction, all accessible within the Wallet app. No separate banking login required. Shopify. Merchants can apply for Shopify Capital business loans directly in their dashboard. Approval relies on sales data and platform metrics, bypassing traditional bank paperwork. In the third quarter of 2024, Shopify originated $837 million in loans, totaling over $2.1 billion year-to-date, all embedded in the e-commerce platform. Amazon. Sellers invited to Amazon lending access growth capital based on their sales performance, right in Seller Central, without approaching a bank. Over $3 billion has been issued since inception, fueling inventory purchases and expansion. Starbucks. The Starbucks app holds over $1.5 billion in prepaid customer balances, effectively an interest-free loan from millions of users, managed seamlessly in-app, showing how a coffee brand can operate bank-like functions without a banking license. Embedded finance spans a spectrum of services: payments, in-app wallets, one-click checkout, instant payouts, loans and credit, point-of-sale financing, merchant capital, microloans embedded in platforms, insurance, buying coverage directly at time of service, rideshare accident protection, travel insurance at ticket purchase, etc. Investment tools, micro-investing or roundup features integrated into retail or budgeting apps, banking services, digital accounts, debit credit cards, savings features accessible in non-bank contexts. Why embedded? Because finance recedes into the background. You don't think I need to open my bank's app. You simply perform an action in an app you trust, and the financial service operates invisibly beneath. Platforms become all-in-one ecosystems. Shopping, ride-hailing, or ordering coffee, combined with the financial rails needed to pay, lend, or save, blurring lines between tech company and bank. This transformation is not trivial. It's tectonic. Legacy banks risk obsolescence if finance shifts into everyday platforms. Meanwhile, non-financial companies unlock new revenue streams: interchange fees, interest revenue on deposits, lending income, insurance premiums, and deeper user engagement. The embedded model elevates user experience: fewer redirects, fewer friction points, and more contextually relevant offers at the moment of need. But how did we get here so fast? Why is embedded finance exploding now? And what should you watch for as these services proliferate? Those questions drive Section 2. But before diving there, let's pause. Imagine a world where you never visit a bank branch or even think about the bank. Every transaction, paying for groceries, receiving your gig paycheck, or financing a purchase, happens naturally in the apps and devices you already use. That future is arriving sooner than most anticipate. Why is this trend exploding? First, picture your own impatience. You open an app to buy a gift, hail a ride, or check orders, only to be jolted into a separate banking portal, asked to re-enter details, wait for verification, That friction jars modern expectations. Embedded finance obliterates these detours. One tap in the app you already trust, and payment, lending, or insurance is delivered instantly. This frictionless experience isn't a luxury, it's table stakes. Studies show checkout completion can rise by over 10% when payments are embedded natively rather than redirected. Next, consider trust. Tech titans like Apple or Amazon have spent years cultivating loyalty, sleek design, reliable service, brand familiarity. For many users, tapping Pay with Apple feels safer than opening a legacy bank app they seldom use. This shift in trust tilts the balance. Non-financial platforms can onboard users into financial services under a familiar roof, sidelining banks that lack that seamless presence. How does embedded finance affect you? For consumers, faster, seamless services, one-click payments, instant payouts, point-of-sale financing all in the app you already use. Picture checking your gig earnings and paying bills in one place, or financing a purchase at checkout without separate credit forms. This convenience can simplify money management and reduce cognitive load. Personalized offers. Platforms leverage granular behavioral data to present tailored loan or insurance offers precisely when you need them, e.g., rideshare accident coverage offered immediately after a trip, or buy now pay, later options surfaced when booking travel. Personalization can boost relevance but also risk nudging you towards services you might not fully need. Less dependence on traditional banks. As financial services migrate into familiar apps, you may find yourself using fewer standalone bank accounts. This reduces friction but can concentrate your financial data and exposure within a handful of tech ecosystems. Risks for consumers. Data privacy and surveillance. Embedded finance thrives on data. Spending patterns, location history, behavioral insights. Platforms may know more about you than any bank ever did. How is this data stored, shared, or monetized? Be vigilant. Review privacy policies, opt out where possible, and demand transparency about data usage. The future of embedded finance. Close your eyes and envision. Your smart car orders insurance renewals automatically as mileage thresholds hit, or pays tolls and charging fees seamlessly via an embedded wallet. Your smartwatch splits dinner bills peer-to-peer instantly when you tap. Your connected refrigerator reorders groceries on credit, charging the embedded wallet. These scenarios are not science fiction. Prototypes already exist in usage-based insurance pilots and IoT payment experiments. Banks' evolution. Traditional banks face a crossroad: be front-end innovators or become back-end enablers. Many choose the latter, offering banking-as-a-service platforms that supply regulated infrastructure for fintechs and non-financial companies. In this model, your banking relationship may be invisible. You use brand X's wallet, but the underlying account and compliance reside with a partner bank. Success demands agility, robust API ecosystems, and partnerships across industries. Emerging careers and opportunities. The embedded finance revolution spawns new roles: API product managers, fintech integration specialists, compliance as code engineers, embedded banking strategists. Entrepreneurs can carve niches: vertical-specific financing in healthcare or education apps, microinsurance embedded in gig platforms, loyalty wallets with integrated savings. The key is identifying user pain points where finance, delivered seamlessly, adds tangible value. Risks, challenges, and ethical considerations. Concentration and systemic vulnerabilities. If a handful of platforms dominate embedded finance, outages or cyber attacks could disrupt large swaths of payments and credit simultaneously. Financial inclusion versus exclusion. While embedded finance can reach underserved users via apps they already use, it can also leave behind those without smartphones or stable internet. Inclusive design and alternative channels remain vital. Imagine you're at the helm of your financial destiny in this embedded era. What role will you play? Will you harness these new tools, embedding seamless payments or launching a niche financing service? Or will you safeguard your own finances by diversifying beyond any single platform? At Finance Facts, we're here to guide you through this transformation. Drop a comment below. What embedded financial feature would you build if you could? Whether it's instant microloans in a niche app, usage-based insurance triggered by your smartwatch, or a budgeting tool that rounds up crypto purchases automatically, share your vision. Smash that subscribe button and ring the bell to stay ahead of the curve as we explore the next frontiers where technology and finance converge.